Hello everybody, my name is Nicole and I'm a technical analyst and private investor. And today, as when even President Trump is called out for potentially spreading incorrect information on social media, you know that fake news really is a very, very big problem. And in terms of investors, I should warn you that the headlines and the current meme, which is the market is doing fantastically and has got itself completely dislocated and dissociated from the real US economy. Well, number one, the market is not just the NASDAQ index. That's the only one that's within spitting distance of this year's all-time high. Other indices are not nearly as pretty. And so I thought we'd look at the Russell 2000 index first, as that is a much broader and more inclusive look at how different North American companies are doing. And this is a weekly chart. It's got the 50 and 200-day moving averages. And you can see that in the collapse in March, these crossed to what we call a death cross. They're pointing down and they've crossed to negative. The bounce that we've seen since the March low, you can see has now retraced 61% of previous declines, and it's taken us back to roughly where we were 2 and a bit years ago. So it's hardly dislocating from the economy. It had a real jolt and now it's sort of coming back onto a more even keel. The point is, it's still below the 200-day moving average, and the averages are still bearish. So I would suggest that this is a corrective bounce that we've seen so far. Yes, it's been big, but then when you lose almost 50% of the rally since 2009 in the space of 4 weeks, well, obviously the bounce is going to be in proportion to the previous decline, and that's what we're seeing. Moving on to my second chart, it's a rather sorry little specimen. This is a chart of the IBEX index in Madrid, top Spanish shares. And again, it's a weekly chart. Again, you see the 50 and 200-day moving averages and their death cross. We've only just this week managed to claw our way back above the 50-day moving average. And we have retraced roughly 1/4 of the March decline. So, I mean, here you can see that while the drop was big, it's really very unimpressive. Sadder still is that the rally was from lows that we had already tested and bounced from over many years. I've written down the bottom there for you to see. And at 7,200 and a bit today, we are less than half peak value of 16,000 in 2007. So we're way below the record high, way below that. And then looking across the Atlantic, I thought we'd look at Mexico because, of course, their economy is closely tied with that in the States. They became one of the first, what they call maquiladoras, which assemble products to be exported into the United States, cars mainly. And this Mexico IPC chart is a monthly one, and you can see that the all-time peak was in 2017 at 51,770. We then dropped quite a chunk, but more steadily over several times, 2 and a bit years. And now we've recovered, but we've only recovered at 23%. That's a Fibonacci retracement level of the more extended decline. So here, clearly, we are nowhere near peak, and the virus and all the associated issues are reflected in the index in Mexico. Thank you all for watching me. I look forward to seeing you again next week, and I hope I'll be able to come up with some other interesting charts for you.